Okay, read this slide. Okay. Now, what do we mean by beta? See, while investing in stocks, we need to look at the stocks from analytical point of view. So we want certain factors which can help us out in calculating or making some sort of calculations which will help us to understand that whether this company's stock is a good bet or not. Okay, whether I should invest into this company or not. Now there are two things which will be helping us out in coming to such sort of calculation. So risk and return. All right, now if I want to see the risk attached to a particular security, I need to calculate the beta for that. Okay, the beta will tell me what is the sensitivity of a particular stock to the movements in the overall market. Let's say if I am going to purchase an ABC Limited company, okay, if I'm going to purchase the shares of an ABC Limited company, now in that case, if I want to see before investing that if the share market is going to move down by 10%, what will be the percentage change in the you can say the share price of this ABC Limited company? Okay, or not share price, what will be the change percentage in the return of this particular stock? So what I'm saying is, let's say if Sensex, the return of Sensex falls down by 10%, right? And my company is listed on BSC, ABC Limited company, the one which I'm targeting to purchase. So I want to see that if the Sensex is going to fall by 10%, will this particular stock move up or down? First question. And then second is, in whatever direction it will move, by what percentage it will move. All right. So here I want to see that how sensitive is this stock with regard to the movements in the market. Okay, so beta is the factor which help us identify this sensitivity level. All right, so in any company's stock, there are two components with regard to the risk. One is the if I'm saying total risk, Okay, I'm writing it down in the chat window. So whatever risk we are going to face on a particular stock, that will be called as the total risk. Okay. Now, second thing is, that is total risk. But this total risk is a combination of systematic and unsystematic risk. Okay, so it is a combination of systematic and unsystematic risk. Got it? Now what happens? Both of these risks are different to each other, are exclusive to each other. Okay. Now, unsystematic risk is that risk which can be diversified, which can be reduced through some sort of strategies. All right. Systematic risk is that risk which cannot be reduced, which cannot be dealt with. This is the risk which we are ultimately required to face. Simple. Okay. This is because of the system itself. All right. So before I move ahead with the explanation of beta, let me explain systematic and unsystematic risk in detail, because only then you will be able to understand beta properly. And then standard deviation and other factors, because beta, standard deviation, R square, all of then Sharpe ratio, Tanner ratio, all of these types of factors are going to be discussed in the coming classes, and you need to have understanding about the fundamentals which are discussed in all of these factors. Okay, so how do we define systematic and unsystematic risk? How do we identify that what type of a risk is called systematic risk and what type of a risk is called unsystematic risk? All right. Now, let me give you an example. So let's suppose you are riding a two-wheeler. Okay. Now, excuse me. Now you are riding a two-wheeler. Now, in this case, there are two types of risk which you will be facing. One is systematic and the one is unsystematic. Okay. So what type of risk will be unsystematic and what type of risk will be systematic in this case of this particular rider? So the activity of rash driving by this very individual will be unsystematic risk, because it is specific risk, specific to that individual's style of driving. Okay, the expertise of that individual with regard to driving, the you can say the condition of the vehicle of that individual, again, whether the brakes of that vehicle are working properly or not, whether the tires of that vehicle have good grip or not, whether the alignment of that vehicle is proper or not. Okay, so all of these things fall under the category of unsystematic risk, or you can say individual risk, or you can say specific risk, right? Because I can change the tires, I can get the alignment corrected. Okay, I can stop driving rash. I can maybe wear a helmet. Even if I face an accident, I may try to save myself with regard to head injury. I can wear an elbow guard and a knee guard as well to protect myself, and then I can drive properly and with 100% care on the road so that nobody else come and hit me. Okay, so these are the strategies of reducing the unsystematic risk. So unsystematic risk is the specific risk, that is the individual risk. It is because of that very individual. Now, in case of a company, I can say the risk which is faced by a particular company specific to itself. For example, the labor which is working in the company may go on a strike. The product which is manufactured by the company, the quality of that product is poor and is not of acceptable levels. All right. Then maybe the management of the company is not strong and do not have, you can say, incongruence to each other, or in proper understanding with each other, right? So all of these types of risks are specific risks to a company. Now these risks can be diversified. I can try to have proper, better welfare, labor welfare policies in my organization so that none of my labor goes on a strike. Okay. Another thing is I can try to incorporate better manufacturing practices. I can try to procure better quality of raw material for manufacturing my final product. All right. So all of these things can be diversified. These types of risks can be diversified, and we can save the company from the possible future loss, financial loss. Now, coming back to the rider, doesn't matter how careful that rider is, doesn't matter how many protective gear that rider is wearing. Okay. Doesn't matter how carefully the rider is riding the vehicle, the individual may still get into an accident because of the carelessness of somebody else, right? Doesn't matter this individual is careful, but there are still a chance that because this individual is riding that vehicle, is riding that vehicle on a public road, and public road is for public transport, so there are going to be other riders as well. So this individual is in the system of the public transport. So because the individual is there in the system, the systematic risk of the system, that is the chances of happening of getting into an accident because of bad driving of the other individual, right, are still there. And that cannot be controlled. I cannot control the driving of other individual. What I can do is to make sure that even if I face an accident, I may try to reduce my injuries. That is the only thing I can do. Okay. So in this case, this is the risk which is undiversifiable. It cannot be diversified. All right. So now, exactly in the case of a company, the systematic risk is always there. So we can always diversify an unsystematic risk, but we can never diversify a systematic risk, right? I hope the difference is clear to everybody. Now, if I am a company and I'm there in the system, so I'm bound to face the systematic risk. So every FMCG company will be facing these similar systematic risk. Every automobile company will be facing the similar systematic risk. Every you can say real estate firm will be facing the similar risk. Okay, so I cannot diversify it. So I have to consider, I have to do my calculations by keeping in consideration the systematic risk which is there, right? So that is all about systematic and unsystematic risk. Now beta represents systematic risk. Okay, remember this always. Beta represents systematic risk which is faced by a particular stock because it is in the system. So if the system, let's say if the now what type of systematic risk could be there for a particular company? The economic stability and instability. All right, because of COVID, every single company faced an issue with regard to their returns, right? So it is because of the system. It is because the company is operating in an economy, because the economy has faced losses in total. The every single company which is attached to that economy, which is working under that economy, is bound to face the losses. Okay, then next is government policies, right? For example, the demonetization which came few years, 4 years back, so 5 years back. So during that time, again, it is because of the government policies, the impact of that demonetization was faced by every single company, right? On the other hand, let's say this GST implementation again, right? That is again a government policy. So these are because of the system. So whatever we do, we cannot diversify the systematic risk. So we need to make calculations with regard to the systematic risk, and the systematic risk can be you can say can be we can get an idea about the systematic risk which is faced by a particular company through the calculation of beta. All right. So beta tells me that how sensitive a stock is with respect to the movements in the economy or the sector or the overall market in which it is working. So let's say the overall automobile company, automobile industry, it starts falling down and it falls down by 10%. So I want to see what is the beta of Tata Motors, what is the beta of Mahindra, what is the beta of Suzuki, what is the beta of let's say this Volkswagen, what is the beta of Ford and General Motors and others. Okay, so all of these companies will have different beta values because all of these companies will be wearing different types of helmets. All right, so they cannot diversify the systematic risk, but a little difference will be there because of the operations of these companies, right? So the bigger the company, the more expensive you can say the operations of the company, the company will be having different responses to the changes in the market. Okay,